Welcome to the Opening Bell Report.
85%. I mean, just let that number sink in for a second. 85%.
Wow.
Right? If I told you a stock was up that much,
Yeah.
85% in just 12 months, what's the first thing that, comes to mind?
I'm thinking some crazy meme stock, right? Some obscure crypto or, a penny stock that just got massively pumped.
Exactly. It sounds like speculative mania, something that's probably about to crash hard.
For sure.
But what if I told you that number, that 85%, belongs to a massive industrial mining giant, a company that, literally digs rocks out of the ground?
Well, that's a staggering return for a company of that size. We are not talking about some small cap here. This is a major player.
We are talking about Southern Copper, ticker symbol SCCO. And if you have the chart open right now, and let's be honest, if you're listening to this, you probably do, your jaw is likely on the floor.
Oh, yeah.
It just hit a new all-time high of $186.25.
It's a vertical line. The chart is just,
Yeah.
It's absolutely vertical.
And that brings up a very specific, a very uncomfortable feeling, doesn't it? That little pit in your stomach. The FOMO factor.
Oh, yeah. The classic dilemma.
You look at that chart and you are torn between two screaming thoughts. Thought one is, I am an absolute idiot. I missed the boat. Why didn't I buy this a year ago when it was boring?
And thought two.
Thought two is just, it's pure fear. It's, if I buy now at the absolute top, it is going to crash 5 minutes later and I am going to be the sucker.
It's the ultimate investor's trap. Do you chase the momentum or do you run from the hype?
Exactly. So that is the mission for this deep dive. We're unpacking a new analysis report called Southern Copper Analysis, the revaluation of a mining king.
Right.
And we are going to strip this thing down and answer the one question that really matters right now. Is it too late? Is $186 the ceiling or is this just the beginning?
And I think the answer in this report is going to surprise a lot of people. Because the core thesis here isn't about hype or momentum. The argument is that the market isn't getting this wrong. The stock isn't being overvalued.
Okay.
It's being revalued. And that's based on a completely new economic reality.
Revalued.
Yeah.
I like that. I like that a lot because it implies there's a reason, there's some kind of rationality behind the madness.
Exactly.
But I'm going to need you to prove it. Because when I look at the traditional numbers, as the report calls the scary numbers, I get very, very nervous. Let's get into that valuation trap.
Let's do it. So what's the first thing that scares you on the page?
The PE ratio, the price to earnings. It's the, the standard yardstick. How expensive is this thing relative to the actual money it makes?
Right. It's the first stop for any investor. Am I getting a deal or am I getting ripped off?
Southern Copper is trading at roughly 39 times earnings. 39?
Which is, historically speaking, that's high.
High. It's astronomical for a miner. If I'm buying a software company that can scale infinitely, sure, I'll pay a 30, 40 PE. But a copper miner, they are digging heavy rocks out of the earth. It's slow, it's capital intensive.
You're absolutely right to be skeptical. If you look back at the mining sector, these stocks usually trade somewhere between, say, 15 and 25 times earnings. That's the normal safe zone.
So at 39, we're essentially paying double the normal sticker price.
Pretty much.
It feels like paying Ferrari prices for a dump truck. And usually, that's a recipe for disaster in commodities.
That is the perfect bear case. You are paying double for a boring mining stock. But here's where the report just flips the script.
Okay.
It argues that you're not paying for a standard miner anymore. You're paying for what they call tech-like growth.
Tech-like growth
Yeah.
from a commodity stock. I mean, come on, that sounds like pure marketing spin. How do you justify that?
You have to look at the velocity of the money. So look at the year-over-year numbers. Revenue is up 12.7%.
Okay, that's solid.
Yeah.
But it's not earth-shattering. It doesn't justify a 39 PE.
No, it doesn't. But look closer. Look at the net income.
Go on.
It's up 26.2%.
Wait, hold on. So revenue's up around 13, but profit is up over 26.
Over 26% growth in net income in 1 year.
So they're becoming way more profitable on every single dollar they bring in. That is operational leverage in action.
Exactly. And you have to understand the context here to see why that's so powerful. Think about the global economy the last 18 months. Think about inflation. What's happening to the costs for most mining companies?
Oh, they're getting crushed. I mean, diesel for the trucks is more expensive. Labor wants higher wages, explosives, steel. Everything costs more. Inflation hits heavy industry the hardest.
Precisely. So most miners are seeing their margins get squeezed flat or even shrink. They're selling more copper, but it costs so much to get it out of the ground that their profit is just stagnant.
It's like running faster just to stay in the same place. The Red Queen effect.
But Southern Copper, they are expanding their margins in this inflationary environment. While everyone else is struggling to tread water, these guys are swimming laps.
Okay, so that explains the premium. The market is looking at SCCO and saying, We will pay extra for you because you're the only one who has figured out how to beat inflation.
The report has a great analogy for this. It says you pay a premium for the only car on the racetrack that isn't breaking down.
Like that.
If you are the only reliable growth engine in a sector that's struggling, you get the premium price tag. You get the tech valuation because you're putting up tech efficiency numbers.
Okay, I can see that. It's a flight to quality.
Hmm.
But there's another layer to this, right? It's not just about them being good in a vacuum. It's about the competition.
Yes. The competitor smackdown section. This was, I think, the most illuminating part of the entire analysis.
It was absolutely brutal. Because look, if I want to buy copper, I'm usually looking at the big two. Southern Copper or Freeport-McMoRan, ticker FCX.
The household name.
Right? It's what everyone on TV talks about.
Yeah.
And the value guy in me usually says, hey, just buy Freeport. It's cheaper on a PE basis.
It is cheaper on paper. But the report asks a really blunt question. Why settle for cheaper if the quality is just vastly different? And they use this secret weapon metric to prove it.
Secret weapon sounds a bit dramatic, but it's a very grounded financial metric.
It is. They focus on cash flow quality.
Okay, let's break this down, because terms like cash flow get thrown around a lot. What are we actually measuring here in plain English?
It's really simple. For every $100 of sales that comes in the front door, how much of that actually ends up in the bank as cold, hard cash?
After you pay for everything.
Everything. Operations, maintenance, taxes, new equipment. It's the money you can actually use to pay dividends or buy back stock. It's the difference between revenue and reality.
Okay, so let's do the comparison. Freeport-McMoRan.
For every $100 in sales, FCX keeps about $6 in free cash flow.
$6. That feels incredibly thin. I mean, if my lemonade stand only kept $6 for every 100 I sold, I would seriously rethink my business model.
Well, it's pretty typical for a capital-intensive business. Mining is expensive, so 6% isn't bad. It's just standard.
All right. So what about Southern Copper?
For every $100 in sales, Southern Copper keeps $28.
28.
$28.
Whoa. Okay, that is nearly 5 times more efficient.
Yeah.
That's not even in the same ballpark.
It's not even the same sport, and that is the aha moment from the report. Why is SCC trading at a higher multiple? Because they are nearly 5 times more efficient at generating actual spendable cash.
How is that even possible? It's the same element, copper. They sell at the same global price. How does one keep $6 and the other keeps 28?
It's not magic, it's geology and geography. It all comes down to their structural advantages. The report points to their massive reserves in Peru and Mexico.
So location, location, location.
Hugely. These aren't just big mines, they're high-grade, long-life mines. High-grade just means for every ton of dirt you dig up, you get more copper.
So you move less earth for the same amount of metal, saves on fuel, wear and tear, everything.
Instantly lowers your cost per pound. And on top of that, look at the labor markets. Their operations are in Peru and Mexico. Now, labor costs are rising everywhere, but the cost structure there is still significantly lower than a mine in, say, the US or Canada.
So they have better dirt and cheaper labor.
That's the 1-2 punch. And that combination leads to best-in-class margins, period.
The report had that analogy I mentioned earlier that I thought was perfect. It compared Freeport to Walmart.
And Southern Copper to Apple.
Exactly. Walmart. High volume, razor-thin margins. They move a ton of product, but keep a tiny sliver. That's Freeport.
A volume beast.
And Southern Copper is Apple.
It's a premium product, operational excellence, and just insane margins.
And when you put it like that, suddenly that 39 PE doesn't look so crazy anymore. You pay a premium for Apple. You don't expect it to trade at Walmart's valuation.
Exactly. Quality costs money. And in this market, investors are flocking to the company that actually generates cash, not just revenue.
Okay, so the fundamentals are a beast. The overvaluation is really a reevaluation. I'm sold on that part. But let's go back to the chart, because we are at an all-time high.
We are. And for a technical analyst, this is probably the most exciting setup there is. This is what's called a blue sky breakout.
Blue sky. I like the sound of it, but what does it actually mean in trading terms?
Well, think about what usually stops a stock from going up. It hits resistance levels.
Right, prices where people bought in the past and got stuck.
Exactly. Imagine you bought a stock at 150 2 years ago. It crashes to 100.
Yeah.
You've been holding that losing stock, just miserable, praying for it to get back to 150 so you can sell and just break even.
The dreaded bag holders. Just let me get my money back.
Right. So as the price climbs back to 150, all those people sell. That creates selling pressure, a ceiling. But here's the thing about Southern Copper right now.
It just broke its all-time high.
Which means?
There is no one left above us. There are no bag holders. Every single person who owns this stock right now is in profit.
Nobody is waiting to sell to break even. There's no historical resistance. There is just blue sky.
That is such a powerful psychological place for a stock to be.
It's huge, and the report notes the momentum. It didn't just touch the high and pull back. It closed strong, up almost 3%, and kept moving in after hours.
Which tells you it's not just retail traders tapping buy on their phones.
No, that signals institutional buying. Big money, hedge funds, pension funds, they're stepping in, accumulating, and they don't buy for a 5% pop.
So if there's no resistance, where does it go? What's the target?
Well, in blue sky territory, you can't use past charts, so psychology takes over. And humans love round numbers. The report suggests the next big magnet price is $200.
200. That's tantalizingly close.
It is, but, and this is a very big but, that doesn't mean you should mortgage the house and buy it right this second.
Ah, okay. Here comes the voice of reason. Because everything we've said so far screams buy, buy, buy. The mission was, is it too late? The report says no, but there's a catch.
There's nuance. The verdict is, it's not too late, but strategy matters. The report is very clear on this. Do not chase green candles.
Explain that. If it's going to 200, why not just buy at 186 and ride it up?
Because stocks rarely go up in a straight line, even the best ones. If it spikes to 190 tomorrow, the advice is to let it cool off. Don't let FOMO make you buy the spike. The strategy says wait for a better entry.
So where's that entry? Where do I stand on the platform to catch this train?
The report calls it the golden entry zone. Since we just broke out, the old resistance, that ceiling, should become the new support, the new floor.
So you're looking for a retest of the breakout level.
Exactly. The report says any dip back into that breakout zone, specifically between $175 and $180, is considered a gift.
So be patient. Watch it. Don't buy the hype today. Wait for the inevitable profit-taking to drop it back to, say, 178, and that's your moment.
That's the disciplined approach. Buying at 175 gives you a much better risk-to-reward ratio than chasing it at 186.
And I think that discipline is easier when you understand the bigger picture here. The report ends with this massive macro argument. It's not just about SCCO. It's about what copper represents now.
Yes, this is the why now. The report's claim is that we are witnessing a fundamental shift where copper is the new oil.
The new oil. I mean, we've heard that phrase about data, but they mean it literally here as the fuel for the economy.
As the fuel for the future of the economy. Think about the two biggest technological drivers right now, the AI revolution and the EV transition.
Both are incredibly power hungry.
And infrastructure heavy. You cannot build AI data centers without unbelievable amounts of copper, not just for chips, but for wiring, cooling, power distribution. AI is basically turning electricity into intelligence, and copper is the wire that carries that electricity.
It's the nervous system of the AI body.
Perfectly put. And then you have EVs. An electric vehicle uses 3 to 4 times more copper than a gas car.
Right, in the batteries, the motors, the charging station.
And you have to upgrade the entire power grid to support all this, which is all copper. Transformers, transmission lines, all of it.
So copper isn't just a metal anymore. It's a strategic resource. It's the bottleneck for progress.
Exactly. In the 20th century, you controlled oil, you controlled the economy. In the 21st, if you control high-quality copper, you control the transition to the future.
And if copper is the new oil, then Southern copper, with the best margins and the most efficient cash flow, is the undisputed king.
They're the standard oil of this new era.
And that's the whole argument. The commodity itself is being re-rated by the global economy, so the best company producing it is being re-rated by Wall Street. That's why the PE is to 39. The market is pricing in this new era.
Precisely. The market is looking forward and saying, we don't care what miners used to trade at. We care what this miner will do in a copper-starved world.
So let's just recap what we've unpacked here for everyone listening.
We started with the fear that SCCO is too expensive at 39 times earnings. But we found that premium is justified by tech-like growth and expanding margins when everyone else is getting squeezed.
We compared it to its rival, Freeport, and found SCCO is the Apple to their Walmart. It's nearly 5 times more efficient at turning sales into actual cash.
And technically, the chart is in a blue sky breakout. No resistance overhead with a psychological path toward $200.
And this is the key takeaway. The strategy is to wait for the dip. Don't chase. That $175 to $180 range is your golden entry.
Exactly. It's a buy the dip candidate, not a chase the peak gamble.
It really does change how you look at a mining stock. This feels different than just a boring cyclical trade.
It does. And that leaves us with a really fascinating question. We spend so much time obsessed with historical averages, saying a miner should trade at 15 times earnings because that's what it did in the past.
Right, we cling to old rules because they feel safe.
But if we actually accept the premise of this report, that copper is the literal fuel for the AI and EV revolution, does looking at those historical PE ratios even make sense anymore? Or are we just witnessing the birth of a totally new asset class where the old rules of valuation no longer apply?
That is something to think about. Are we looking at a bubble or a genuine paradigm shift?
Only time will tell, but the data is certainly pointing in a very interesting direction.
Well, there you have it, the bull case for Southern Copper. As always, thank you for diving deep with us. We'll catch you on the next one.
Stay curious.
Don't forget to like, share, and subscribe for more.